December is here. You know what that means. Holiday music, festive decorations, and a mountain of financial deadlines you absolutely cannot afford to miss. Look, I get it. Between the holiday shopping, family gatherings, and maybe even sneaking in a little vacation time, the last thing you want to think about is your finances. But trust me, taking a little time now to tackle these year-end money moves can potentially save you thousands of dollars and set you up for a much more financially secure new year. We're talking about maximizing retirement contributions to really build that nest egg, squeezing in every last tax deduction, and making sure you're not leaving any free money on the table. Because let's face it, who doesn't love free money? So, grab your favorite holiday beverage, get comfy, and let's dive into these crucial December financial deadlines together. By the end of this video, you'll be a year-end financial ninja, ready to conquer your money goals and start the new year strong. First up, let's talk about everyone's favorite retirement plan, the 401k. For 2024, that's $22,500 if you're under 50 and $30,000 if you're over 50. Maximizing your contributions can make a big difference for your future. That's a decent chunk of change, right? But here's the thing. Most people don't even come close to maxing out their contributions. And that's a huge missed opportunity. Think of it like this. Every dollar you contribute to your 401k is a dollar that's working for you, growing tax-deferred year after year. Plus, if your employer offers a match, you're essentially leaving free money on the table if you don't contribute enough to get the full match. It's like turning down a raise. So, check with your HR department to see what your company's matching policy is and make sure you're taking full advantage. Remember, the earlier you start contributing and the more you contribute, the more time your money has to grow. So, even if you can't max out your contributions this year, try to increase them as much as you can. Your future self will thank you. Now, let's move on to IRAs, or individual retirement accounts. These are another fantastic tool for building your retirement savings, especially if you're self-employed or your employer doesn't offer a 401k. For 2024, you can put in up to $6,500 if you're under 50 or $7,500 if you're over 50. Even if you can't hit the limit, adding anything now helps. Every little bit grows over time. Remember, with a traditional IRA, your contributions may be tax deductible, meaning you could lower your tax bill now. With a Roth IRA, your contributions aren't deductible, but your withdrawals in retirement are tax-free. Choosing between a traditional and Roth IRA depends on your individual circumstances and whether you think your tax bracket will be higher now or in retirement. It can get a little complicated, so it's always a good idea to talk to a financial advisor to see which option is best for you. The deadline for making contributions to an IRA for the 2024 tax year is typically April 15th, 2025. However, I'm mentioning it now because the sooner you contribute, the sooner your money can start growing. Now let's talk about a powerful savings tool that often gets overlooked, the Health Savings Account, or HSA. If you're enrolled in a high-deductible health plan, an HSA offers what I like to call a triple tax advantage. Here's how it works. First, your contributions are tax deductible, meaning you're lowering your taxable income right off the bat. Second, your money grows tax-free while it's in the account. And finally, when you withdraw the money for qualified medical expenses, those withdrawals are also tax-free. It's like a trifecta of tax savings. For 2024, the contribution limits are $4,350 for individuals and $8,300 for families. And if you're over 55, you can add an extra $1,000. Now, Here's the catch with HSAs. Unlike IRAs, where you have until April to make contributions for the previous year, HSA contributions must be made by December 31st to count for that tax year. That's right, you only have a few weeks left. So, if you're eligible for an HSA and haven't maxed out your contributions yet, now's the time to act. Even if you can't contribute the full amount, every little bit helps. Think of it like this. You're essentially prepaying for future medical expenses with pre-tax dollars. Plus, the money in your HSA rolls over year after year, so you don't have to worry about using it or losing it like you do with some other health spending accounts. We'll talk more about those in a bit. All right, let's talk about flexible spending accounts, or FSAs. These accounts let you set aside pre-tax dollars for healthcare expenses. Remember the use it or lose it rule. Use the money by the end of the plan year, or lose it. Some employers offer a grace period or rollover. But don't bank on that. It's best to play it safe. Use FSA money on copays, prescriptions, glasses, and dental work. Schedule those appointments you've been putting off. Let's dive into some examples of what you can snag with your FSA dollars. Got kids? FSA funds can cover orthodontic treatment, expecting. Prenatal vitamins and childbirth classes are covered too. Need an eye exam or new glasses? Your FSA can help. FSAs also cover medical equipment like crutches and breast pumps. Check your FSA balance before December deadlines. You might be surprised at how much you can save. Let's be real. Nobody likes paying more taxes than they have to, right? Charitable contributions can help lower your taxable income. By giving back, you can reduce your tax bill. It's a win-win. But remember, you need to itemize your deductions and donate to qualified organizations. Consult a tax professional for accurate information. Let's dive into the details of what qualifies as a deductible charitable contribution. Cash donations are the most straightforward. Just make sure you get a receipt, especially if it's a significant amount. Think of it like an investment. You always want a paper trail. But it's not just about cold, hard cash. You can also deduct the fair market value of donated goods, like clothing, furniture, or even vehicles. Now, there are some rules about this too. The items generally need to be in good condition, and you'll need to get a receipt from the organization stating the value of the donation. Here's another cool thing. You can even deduct certain expenses related to volunteering your time. For example, if you're driving to a volunteer event, you can deduct your mileage. Or if you have to buy supplies for a volunteer project, those costs might be deductible too. The key takeaway here is documentation is key. Keep track of all your donations, whether it's cash, goods, or volunteer expenses. Make sure you have receipts, acknowledgement letters from the organizations, and any other relevant documentation. This will make your life a whole lot easier come tax time. Let's talk about tax loss harvesting. It's a savvy strategy to save on taxes. Sell losing investments to offset capital gains. Selling for a profit triggers a capital gain tax. Selling at a loss offsets those gains, reducing taxes. Strategically, take a loss to cut your tax bill. Tax loss harvesting isn't just about offsetting capital gains. It can also help reduce your overall taxable income. Here's how it works. You can use up to $3,000 in capital losses to offset your ordinary income each year. So, even if you don't have any capital gains, you can still potentially lower your tax bill by strategically selling losing investments. Now, isn't this just a fancy way of selling low and buying high? And you're not entirely wrong. But the key here is to not just sell any losing investment. You want to be strategic about it. Look for investments that have a low probability of recovering in the near future, or investments that you've been meaning to get rid of anyway. The goal is to realize those losses on paper to offset other gains or reduce your taxable income. while still maintaining a diversified portfolio. Of course, tax loss harvesting can get a bit complicated, especially if you have a complex financial situation. It's always a good idea to consult with a qualified financial advisor or tax professional to see if this strategy makes sense for you and to ensure you're following all the rules. All right, guys, let's talk about setting your kids up for success, or maybe even your future self, with a 529 plan. These are college savings accounts that come with some serious tax advantages you don't want to miss. The beauty of a 5029 plan is that your money grows tax-free, and when you use it for qualified education expenses, those withdrawals are tax-free too. We're talking tuition, room and board, even textbooks. It all counts. Now, what's the catch? Honestly, there isn't much of one. Contribution limits for 529 plans are substantial, generally ranging from $250,000 to $500,000 per beneficiary, depending on the state. You don't have to wait until December 31st to contribute. You can contribute any time of year. Just make sure you do it before your state's deadline to qualify for any potential state tax deductions or credits. Speaking of state benefits, that's another perk of 529 plans. Many states offer tax deductions or credits for contributions, so you're essentially getting a little bonus from your state government just for saving for education. Talk about a no-brainer. And here's a pro tip. You don't have to invest in your own state's plan. You can shop around and choose a plan from any state, so compare fees and investment options to find the best fit for you. Remember, the earlier you start, the more time your money has to grow. Even small contributions can make a big difference over time, thanks to the magic of compound interest. Trust me, future you will thank you for being proactive and setting yourself up for financial freedom, especially when it comes to tackling those hefty college costs. All right, let's talk about something we all love: free money. Okay, maybe not technically free, but you know what I mean. If you're using credit cards responsibly and paying them off in full every month, you're missing out if you're not taking advantage of those sweet, sweet rewards. Think of it this way. Every time you swipe your card, you're earning points, miles, or cash back that can be used for travel, statement credits, or even cold hard cash. But here's the kicker. Many credit card rewards expire if you don't use them. Don't let those hard-earned points go to waste. December is a great time to take stock of your rewards balances and see what's about to expire. Some cards have annual expiration dates, so don't assume you have all the time in the world. Now, I know managing multiple cards and rewards programs can seem daunting, but trust me, it's worth it. Set a reminder on your phone to check your rewards balances every few months. Or, better yet, use a rewards tracking app. These apps do all the heavy lifting for you, keeping track of your points, miles, and expiration dates, so you don't have to. And here's a pro tip. If you're sitting on a pile of points or miles, consider using them sooner rather than later. You never know when airlines or credit card companies might devalue their rewards programs, so it's always best to cash in while you can. Remember, those rewards are essentially free money. Use them to treat yourself or offset future expenses. We've covered a lot of ground today, from maxing out retirement accounts to snagging those credit card rewards. And I know it can seem overwhelming. But remember, you don't have to do everything at once. Even tackling one or two of these financial to-dos can make a significant difference in your financial well-being. Start by picking one or two items that resonate with you the most. Maybe it's maxing out your 401k to snag that employer match, or finally opening that 529 plan for your child's education. Whatever it is, break it down into smaller, manageable steps. Use online calculators, Schedule a quick call with a financial advisor, or even just set aside an hour or two this weekend to review your finances. Your future self will be grateful for the steps you take today. Even small steps can lead to big financial wins. Thanks for joining me on this journey to wrap up the year with smart financial moves. If you found value in this video, help us grow by hitting that subscribe button and supporting the channel. Together, we can make financial success simple and accessible for everyone. Let's start 2025 strong. Don't miss out.